After last week's dalliance with the bulls, so many strategists want to pretend that it didn't happen, that nothing mattered, nothing changed. As they see it, last week was nothing more than a short covering rally, a temporary snapback in a bear market rally, a sucker's rally. That's what they see on a day where the Dow advances 35 points, S&P edged up 0.18%, NASDAQ gained 0.3%. Of course, I see consolidation. I dispute that bearish verdict. Although I simply can't dismiss the best week of the year, where major strides were made in broadening the rally to everything from the financials to recent e-commerce stocks to the usual semiconductor and semiconductor equipment suspects. I am not going to throw cold water on those who thought the reversal in the bond market that lowered long-term yields dramatically was just a minor incident, okay? I mean, it was big. Until last week, I was convinced the 30-year was headed for 6%. That's much harder to believe now. The guys who think it didn't matter, I'd just like to dump cold water on them. These were hard-fought victories for the bulls, people. They weren't supposed to happen. They came at a time when the stock market was oversold and the gloom was palpable. But that's true of most enormous rallies. That's how they start. The gains are now being consolidated, even as there were plenty of people who, as always, wanted to ring the register and park this money in CDs. Profits are being taken because there's been so much hardship since late July, when Fed Chief Jay Powell took the possibility of recession off the table, which meant the Fed had more leeway to keep raising interest rates. Long-term interest rates, of course, then soared. But then they stopped when Powell spoke last week, because while he wasn't as sanguine, he did seem hopeful that since we put together a couple of months of inflation trending lower, there could be more good months ahead. Instead of predicting a December-January rate hike like so many people who dismissed last week's action as aberrant, hey, maybe we should just say that the softer data continues, there'll be no more rate hikes. Of course, if any major component of inflation accelerates, including real estate prices, then I think the Fed will tighten again. Powell's not out of the equation, but the data does the talking here going forward. Just as important, the Treasury Department's decision announced last week that I harped on, that no one else did, frankly, to rely on shorter-term debt for the bulk of the government's refinancing in 2024, that gave the bond bears a slim reed of hope to hang on to. See, shorting long-term bonds was a great trade, but it had gotten crowded, and crowded trades are vulnerable. It's amazing that next year's Treasury auction schedule could stop the big short in its tracks, but short sellers were growing quite wary that there might not be enough treasuries for all of them to cover without moving prices up substantially. I kept telling you we had a bond glut, but with fewer long-term bond auctions and the possibility that the Fed will stop selling its own portfolio, that glut will be gone and will be at equilibrium. And if you're short bonds, oh my God. Now, you can frame this as a good short being spoiled, but as I see it, bulls make money, bears make money, and the pigs, well, the pigs, they would have been slaughtered. The bond bears, they had become pigs.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.